This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. Our top stories this hour. Bonds are maintaining losses and stocks are struggling as traders wear slower pace of Fed rate cuts. Wall Street also hit by negative corporate news with an E.coli scare at McDonald's and Starbucks sales plunging. Also ahead, Tokyo Metro shares on track for gains when they debut next hour after strong demand for Japan's biggest IPO in 6 years. And Bank of America CEO Brian Moynihan joins us exclusively and live here in the Sydney studio with his outlook for rates and the economy.
Heidi, we continue to watch risks around the world with the IMF lowering its growth forecast for next year to 3.2%, down 0.1 percentage points. Of course, we continue to see resilience in economies like the U.S., but it's really the global growth forecast that we're watching with ongoing wars and, of course, risks of protectionism. China's growth forecast being downgraded to 4.8%. Of course, that's below the Communist Party's target of 5% for this year.
And a lot of that uncertainty, Shery, comes from, whether the stimulus packages that we've been seeing announced out of China is going to have that long-term effectiveness of supporting a rebound back to better growth. But also, of course, what happens when it comes to the U.S. election when just under 2 weeks away now. And we have heard that, of course, Donald Trump has threatened or vowed to impose 60% tariffs on imports from China, 10% duties on those from the rest of the world. How that would be inflationary, what the fiscal picture remains for the U.S. and more broadly is as just some of those risks, right? And we know the IMF also last week flagged concerns about global public debt expected to reach $100 trillion by the end of this year. Take a listen.
We find that an escalation in trade wars, regardless of where they're coming from, this is not just the U.S., by the way, there's been a lot of increase in trade policy distorting measures by a number of countries in the last few years.
A very different picture playing out in the U.S. as we continue to get solid U.S. economic data, right? I mean, and really traders paring back those aggressive bets of easing, and we have that downside pressure across U.S. stocks, U.S. futures at the moment, with the NASDAQ futures right now down 0.2%. And of course, we had some idiosyncratic events as well. You mentioned McDonald's E.coli outbreak. We've been following that. And of course, we have earnings as well. The results from Starbucks disappointing, Texas Instruments outlook disappointing, 20% of S&P 500 companies reporting this week, and we continue to watch the Treasury space as that sell-off continues. Take a look at how we're setting up for the Asian session because the U.S. dollar has remained steady, but on the other side of the trade, we continue to see weakness across Asian currencies, especially the Japanese yen topping that 151 level. We're watching the 200-day moving average, 151.36 is the level that we're watching for the Japanese yen, and potentially any comments coming from authorities, speculation about intervention in the markets continues. And of course, in the Japanese equity markets, it's all about Tokyo Metro's $2.3 billion listing happening today. So an exciting day ahead for Japanese markets as we continue to watch the offshore yuan holding steady, the Korean won also at a 3-month low against the U.S. dollar. Heidi.
Well, Shery, our next guest sees that no landing scenario when it comes to the U.S. economy. Let's bring Xi Qiao, who's a financial advisor and managing director at UBS. And certainly, if you take a look at what we're seeing across Treasury markets, broadly, these bond traders are in the same camp.
Absolutely. And then we feel like, again, back to the topic of the no landing, the U.S. economy with a no landing scenario, we're certainly supporting equities, and we have upgraded equities again to attractive, and we feel like if there's any excess cash on the side, especially yields have moved up a little bit, but this is the time to invest the cash. I mean, equities, the broader economy, it's supporting equities right now, and so anything, specifically U.S. large cap in tech, as well as just investment-grade bonds are good places to get the cash invested.
You also see that broadly being, pretty positive for global equities as well. Where do you see opportunities at the moment?
Yeah, and then, with the recent China stimulus and also China, having this package and coming up with policy procedures to resolve the property crisis. I mean, this is going to take some time, but that is all positive for global equities, not just, the U.S. markets, but Asia. It is going to have a positive effect on the whole region. So, I mean, U.S. equities has certainly outperformed, but if you look at where the valuations are with international, with global equities, they are at good price points. So it probably takes some time, but this is also a good time if there are dips in the market, especially with upcoming elections, any volatility. Is a good time to not just invest in U.S. large cap, but also preferably, global equities, some of the Asian markets as well.
Is the Federal Reserve a risk for global markets? I mean, the trajectory seems to be towards cutting, but given the economic data that we're seeing recently, I mean, could slower cuts actually be bad for short-term trading?
Actually, I mean, we feel a lot of the cuts has been priced in, and the markets are going to be less sensitive to the cuts because it's going to happen. I mean, it's just, if it's going to happen a lot slower than anticipated, so that could cause more volatility in the markets, but we do foresee probably another 50 basis points, another 100 basis points next year. So, and regardless of the cuts, I mean, the economic data is very strong. Earnings is very strong. I mean, out of, all the earnings that's been reported, 15% are the, largest of the S&P. I mean, 80% has outperformed and beat their estimates. So, I mean, our outlook is pretty attractive for equities and for the markets in general. So the Fed rate cuts are going to have less of an effect unless it's much slower than anticipated.
And there's a lot of enthusiasm across Asia over IPOs and listings. Here in Japan, of course, we have Tokyo Metro today. Is this a positive sign about the moves in the broader equity markets across Asia?
Absolutely. I mean, we're definitely seeing a lot of that IPO, not just IPO, but mergers and acquisition, M&A. A lot of that activity is going to start to come back, not just in Asia, but also in the U.S. So as the economy is getting a lot stronger, I mean, those are all positive signs that we're going to have longer term, better global economic conditions, which are going to support the equity markets.
Are there any specific sectors across Asia or regions where you expect to see more activity?
I think mostly a lot of tech, a lot of internet, state-owned enterprises are probably going to have some of those M&A activity as well. Treasuries, financials, energy, utilities, all of those areas. But specifically, we are very, positive on technology in general. It's driven by all the AI demand at this point. So, that's not just Asia, but U.S. globally, there's going to be that AI demand. So that's going to drive a lot of the economy, a lot of the activity in the markets.
How much conviction do you have over the China stimulus story and the China recovery story?
We feel like the property market is going to be gradually stabilized. I mean, the Chinese are launching a lot more tools to support the markets, local government bonds. A lot of the tools will also be allowed to fund land now that has, land acquisition that, buyback complete but unsold land. So, and a lot of that can be used for, social housing, affordable housing. So, I mean, the prospects are pretty good. It's not going to happen immediately. I mean, a lot of this is going to take time, but it is a very good start. And, and the markets are reacting very positively on that. So, and there's also a lot of favorable tax policies that China's rolling out for real estate transactions. So these are all good signs to hopefully a more better market in China. That's going to drive a better economy, but it's going to take time.
Xi Qiao, financial advisor and managing director at UBS. Good to have you with us. And of course, we're talking about Tokyo Metro, poised to make its trading debut later today. Japan's biggest listing in 6 years, saw over 15 times demand. Our Japan stock reporter Alice French joins us now with the latest. And Alice, I mean, there's a lot of enthusiasm here. What are we expecting in the broader markets?
Yeah, so this IPO is a big deal for Japan, and not least because the Metro is a household name for many people. As you mentioned, this is the biggest IPO that Japan's seen since SoftBank listed in 2018. The national and Tokyo metropolitan governments that jointly own the Metro have raised $2.3 billion with this, which, to put that in context, so far this year, in total, the Japanese IPO market has only raised $1.1 billion. And that's compared to last year, we saw $4.4 billion raised. And And so the IPO market in general has been a little bit slow this year, and there are expectations that this one could really kind of reinvigorate that market and bring the total figure closer to what we saw in 2023. I think as well the timing of this IPO is significant, right? It comes ahead of the election this weekend. There's been quite a lot of anxiety in the markets this week as people are still not sure what the outcome of that will be, and of course the US election in coming weeks too. So it really will be a test of the appetite for Japanese stocks in general, I think.
Yeah, quite an interesting time to to start trading, right? But you talked about how Tokyo Metro is really a household name, but what about dividend yields, and basically how good of an investment is this, because this demand is incredible?
Absolutely, yeah. So I think definitely the relatively high dividend yields are behind the demand, at least in part. We're seeing around 3.3% dividend yield, which is pretty high compared to around 2% on average across land transport stocks. But I think also, you know, the metro and infrastructure stocks in general are seen as quite a stable investment at a time when a lot of people are a bit worried about volatility. And of course, like you mentioned, there's sort of this general consumer affection for the metro too, which I think has also been driving excitement, as well as the perks that the metro has been offering too.
The metro is well known, obviously well loved as a public service. What's the mood like when it comes to the kind of broader public, right? Is there excitement?
Yeah, definitely. So as you say, the metro is very well loved. Around 6.5 million people ride it every day. It's known for its cleanliness, its orderliness and its reliability amongst not just locals but tourists too. My sense of what's going on the ground is that people are generally positive about this. There's a lot of excitement about the prospect of potentially holding a slice of a household name. But I have also been hearing a few concerns. I actually spoke with some of Tokyo's train spotting community last week. They were a bit worried that standards could slip when the metro is having to sort of answer to shareholders. Particularly there were some worries about the quality of the toilets at the metro stations. The metro is known for having clean working toilets at every station, and there were some concerns that that might be one of the first services to go if costs have to be cut.
What about shareholder perks that are on offer, right? What are they? You know, what was sort of the motivation behind introducing them?
So the metro is offering a range of perks to shareholders that buy at least 200 shares. You can get things like free train tickets. Also, the metro owns a chain of soba noodle restaurants across some of their stations, and you can get free toppings on your noodles. You can also get free entry to the metro's museum in Tokyo too. So I think these sort of perks are really trying to tap into that retail investor base of income. Retail investors are becoming a growing force in Japan's stock market as, you know, corporate governance reforms come into play. And I think also in this time of volatility that I mentioned before, you know, retail investors are really seen as a reliable and long-term source of income for these companies. And so really trying to tap into that domestic household income. I think these perks will be good for that. And I have heard some investors say that actually they signed up for shares solely because they want the perks. So it does seem like it has been fueling the excitement.
Our Japan stock reporter Alice French there. Coming up on the Asia Trade, Bank of America CEO Brian Moynihan is on his first visit to Sydney. He joins us exclusively live from the studio here with his outlook for banking in Australia and whether it's a growth market, his views on the Fed and the US economy and the upcoming US election and more. But before that, Lightstream Research joins us to preview Tokyo Metro. Trading debut, I'm a bit excited about this one, Shery.
Yeah, the Tokyo Metro's trading debut, $2.3 billion, right? The head of Blackstone's biggest business tells us how it's driving gains. Much more ahead. This is Bloomberg.
The decision to do this is not one we take lightly, and it was made in close consultation with the CDC. It's important to note that the majority of states and the majority of menu items are not affected. Other beef products at McDonald's, including the cheeseburger, hamburger, Big Mac, McDouble, and the double cheeseburger, are not impacted.
McDonald's USA President Joe Erlinger there, and take a look at what we're watching when it comes to the after-hours reaction. Still, McDonald's trading lower by just about 6%. This is one of the negative corporate stories that move markets lower overnight as we continue to monitor this situation. It did drop more than 10% in post-market trading before paring some of those losses there. Well, the CDC says McDonald's quarter pounders are linked to that E.coli outbreak in the US that has killed one person. For more, let's bring our equities reporter Carmen Reinicke. And Carmen, really good to have you with us. What do we know in terms of how this has unfolded?
Yeah, so what we know right now is that there are about 10 people hospitalized. Most of the affected are in Colorado and Nebraska. The CDC issued this warning about a severe E. coli outbreak that's tied mostly to the quarter pounder. The company McDonald's said that it's taking swift and decisive action to stop the outbreak. We saw shares fall as much as 10% in post-market trading here in the U.S. The stock has pared some of that loss and is trading, as you saw earlier, down around 6%. The company also said that slivered onions might be the culprit. So local restaurants in Colorado and Nebraska where the outbreak is taking place have been advised to remove them from their menu. Suppliers as well, such as Tyson Foods and Lamb Weston, also saw their shares drop in after-hours trading here in the U.S.
Carmen, this is, of course, not the first time that we're seeing contaminated food coming from major chains. Chipotle, for example, comes to mind. How do these outbreaks usually play out for company business?
Yeah, I think the severity is most important and how quickly the companies work to stop the outbreak. Obviously, in this case, McDonald's has taken very swift action. It can be seen in earnings if it's something that becomes a bigger problem, but if not, these companies are so large, they have very large supply chains. McDonald's is already working, it said, to repair the slivered onions issue, or get a different supplier in its supply chain to make sure that this problem doesn't continue to exist. So it's definitely something to watch, but these big companies definitely have a lot of mechanisms in place to deal with these sorts of things.
But as I mentioned, I mean, we have seen these major companies actually suffer from these contaminated food outbreaks, right? Anything being done in the regulatory side of things to try to avoid these outbreaks?
That's a really great question. I mean, I think that that's something that we have seen in the U.S. and that regulation has been stepped up in certain industries to make sure that this doesn't happen. I think it sort of remains to be seen in the case of McDonald's if there is any further if this leads to any further regulatory action. What we know right now is sort of what the company is doing to immediately address the outbreak.
Equities reporter Carmen Reinicke there. And a reminder that Bank of America CEO Brian Moynihan joins us exclusively in our Sydney studio at 8 a.m. Hong Kong time. That's 11 a.m. in Sydney. You don't want to miss out on that exclusive conversation. More ahead, though, coming up on the Asia Trade. This is Bloomberg. Take a look at what we're watching when it comes to oil trading at the moment as we continue to monitor developments in the Middle East. We are seeing a little bit of a pullback there when it comes to New York traded crude after earlier advances there. These tensions continue to simmer between Israel and Iran, strikes continuing amid these ongoing U.S. efforts to try and broker that ceasefire. And that is why we see the U.S. Secretary of State Antony Blinken in Israel again as the Biden administration makes a last-ditch push for ceasefires in Lebanon and Gaza before the election. There seems to be agreement that the killing last week of the top Hamas leader opens new paths to ending the conflict in Gaza. Let's bring in Michael Heath now. This was sort of one of those sort of speculative catalysts for an off-ramp.
Look, they obviously they spoke for 2.5 hours apparently, and as you mentioned, they agreed that the killing of Sinwar does sort of change the picture. The question is that they seem to differ on what those changes are. The US sees it as an option for bringing the conflict to an end. And trying to, set the scene for a day after, sort of what the region looks like, what peace would look like as well. Prime Minister Netanyahu, as he sort of had done for quite some time, sort of indicated that they've got Hamas and Hezbollah in South Lebanon on the run, and they don't intend to let up on the pressure at this stage. So, I mean, that can change. It's obviously this is almost a lame duck administration now, and this is the 11th visit by the Secretary of State since that attack. So, him walking away with nothing much there wouldn't be a huge surprise. What is curious is that he's also due to visit Saudi Arabia, and Saudi Arabia may well end up being sort of a key player here, because the US wants the Palestinian Authority, which runs the West Bank, to sort of take over in Gaza and for them to be a merged group. Israel rejects that. Israel has a point to some extent, because the Palestinian Authority is deeply unpopular in the West Bank where it governs. And whether it could actually run Gaza is an open question. So the question is who would do it, and that's where Saudi Arabia and potentially an Arab force might come into play.
Mike, what's the latest on Hezbollah? And of course, we continue to see the bombings in Lebanon as well by Israel. We've heard that potentially the successor in the Hezbollah leadership has also been eliminated.
Yeah, that's right, Shery. There was a significant bombing undertaken by Israel about 3 weeks ago, and they suspected that the successor to Nasrallah had been caught in that bombing attack, and now they've confirmed that. So that sort of puts throws the leadership of Hezbollah into further disarray if the successor to your leader's gone as well. And they've lost so many senior officials during this past few weeks of fighting, but it hasn't dimmed their ability to strike back. I mean, thousands of Israelis were forced to air raid shelters just before Secretary Blinken arrived in Israel yesterday, because Hezbollah was firing projectiles and missiles which Israel shot down, but it's still got the capacity to keep attacking Israel there.
Bloomberg's Michael Heath there with the latest and some of the other stories that we're following when it comes to geopolitics. And the FBI is investigating the leak of classified documents that detailed Israeli preparations to retaliate against Iran. The two leaked documents emerged late last week on the Telegram messaging platform. They showed Israel conducting covert drone activity and preparing weapons. The incident also highlights how the US routinely spies on its own allies. American intelligence agencies say Russia and Iran may stoke violent protests inside the US after the presidential election. A declassified assessment says foreign actors may encourage or amplify physical threats of violence against election workers and politicians. The partially redacted document also claims that Russia-backed agents would become more aggressive if Kamala Harris beats Donald Trump. The Chinese and Indian leaders have praised closer ties with Russia in separate meetings with Vladimir Putin during the BRICS summit. President Xi Jinping says their deep friendship won't change despite chaos in the world. And Prime Minister Narendra Modi praised close and deepening ties. The BRICS summit of 32 countries is the biggest hosted by Russia since its invasion of Ukraine. More ahead on the Asia trade. This is Bloomberg.
The International Monetary Fund has trimmed its global growth forecast for next year. It now sees global output expanding 3.2% compared with 3.3% in July. IMF chief economist Pierre-Olivier told us how risks to the downside are building.
There's a lot of resilience in the global economy, and it's a lot of resilience despite the fact that inflation has been coming down, despite the fact that central banks had tightened interest rates tremendously over the last 2 years. So that's kind of the good news. Inflation is now close to target. The battle against inflation is almost won. There are maybe some residual risks out there in terms of inflation path, but, really this is good news. Economy being resilient, yes. But we see the risks of adding up, and we see them to the downside. And among those risks, we see geopolitical risks, the Middle East, oil prices, commodity prices. fragmentation, trade wars, tariffs. This is certainly a risk that is on the horizon. We're seeing also, as my colleague Tobias Adrian has mentioned, the fact that right now markets are still very buoyant. Valuations are fairly high. This is risk on. That could change. We had a taste of that in early August. That went away, but we have to be a little bit careful about change in financing conditions.
How interconnected are all of these things? And I'm talking on a country-by-country basis. As you know here, the globalization that brought us to where we are today has seen some fractures, some cracks here. And I'm wondering, is there any argument to be made that some of the concerns that you're raising now may be isolated to certain countries and regions?
Well, when we're looking at some of these risks that I've just outlined, and we've done a scenario analysis in our latest report published today, what we're saying is that really they affect almost all regions in the world. And so, if you have an increase in trade fragmentation, increase in tariffs, if you have financial conditions tightening, this is something that is going to weigh down on growth and activity in all regions in the world.
We talked about central banks like the Fed tackling inflation without actually tipping the economy into recession. You've called this a major accomplishment, Pierre-Olivier, in part because it defies history, right? You don't expect that to be the outcome. What do you chalk it up to? What's different this time?
Well, we really looked in details into that episode, the surge in inflation and coming down in the report. And let's be honest, a good chunk of the disinflation is coming from the fact that the shocks themselves that led to the surge in inflation in the first place went away. Some of the tightness in, supply chains and the bottlenecks and all of that went away. They were responsible for part of the increase in prices, and they're responsible for the fact as they eased that prices moderated. Some of the demand pressures also went away. Some of it's coming from central banks tightening. So there's certainly a role for monetary policy, but it's alongside also some of the shocks waning.
The IMF chief economist speaking there with Bloomberg's Romain Bostic and Scarlett Fu. Well, Thailand's central bank governor says last week's rate cut was warranted. Monetary authorities had opted to cut rates by 25 basis points as financial conditions tightened. The BOT governor told us exclusively that the move should not have come as a surprise to markets.
We're surprised by the extent to which the markets were surprised, because if you look at our previous statements and the edited minutes and whatnot, I think the Monetary Policy Committee had conveyed their concerns about financial stability and financial conditions. And we'd always emphasized that we were very much outlook dependent, and that if there were changes in the outlook, that we would undertake measures. And if you look at again the reasons underlying the decision for the cut, by and large, they were reflecting the fact that financial conditions had tightened, so we felt that financial stability risks were lower, and that a cut was warranted.
Bank of Thailand Governor speaking there to Bloomberg for our news show Insight with Haslinda Amin. We'll have more from that conversation over the next hour. Take a look at what we're watching when it comes to just about 35 minutes into the start of cash trading, as we have that staggered trading now mostly online. When it comes to Sydney, we're seeing actually upside about 0.3%. This could be kind of a buckling of a broader trend, though, as we head into the rest of trading across Asia, because Singapore Nikkei futures are looking pretty much to the downside at the moment. We see really global bonds holding those losses following the global sell-off. And, of course, a lot of excitement, though, in Japan over this IPO, Shery.
Yeah, Tokyo Metro's trading debut, the country's biggest IPO since SoftBank Corp in 2018. Our next guest says the stock offers a lot of value and highlights how cheap Japanese equities can be. Mio Kato is founder of Lightstream Research and joins us now. Mio, great to have you here. Let's talk a little bit about Tokyo Metro's business. So is this a good investment?
Yes, Shery. I think that it looks rather attractive. As we've noted, the valuation actually looks relatively cheap. It looks relatively cheap compared to peers, given the dividend yield is about 3.3% based on the IPO price versus a range of about 1.5% to 2.5% for a lot of rail stocks. And then even in terms of the company's guidance, what we've been highlighting is that throughout history, they've tended to see 1Q seasonality account for about 28.5% to about 30% of the full year earnings, whereas guidance actually implies that it will be closer to 33%. So compared to the guidance of 88 billion in operating profit, if it actually is closer to historical seasonality, you could be looking at something like 95 to 100 billion yen in operating profit, which would make it actually significantly cheaper. So,
looking ahead to the business, though, Tokyo Metro, I mean, this is a very stable business, which is a good thing for a lot of investors. But at the same time, what sort of growth opportunities do they actually offer? They seem to be at potential capacity, and they don't look like they're going to grow or build up more lines.
Yes, I think that it's exactly as you say. The sort of stability or reliability, I think, will be very familiar to all Japanese. In terms of earnings growth, there is a little bit, we feel, because energy costs have risen since the Ukraine war. And given some of their presentations, it looks like potentially there could be about 10 billion yen in further upside if those costs normalize. On top of that, what we'd also flag is that last year they did raise prices for the first time in 28 years. And obviously, there'll be a certain amount of caution given how important the metro is to the livelihood of ordinary people. But just given that wage inflation is starting to take hold, if that continues, we do see the prospect for continued price hikes in line with a lot of wage growth. And personnel costs are about 25% of the overall cost structure. So that could actually be a tailwind for the company. So growth is not going to be stellar, but there could be a little bit there.
A lot of enthusiasm about this stock, right? Oversubscribed, also foreign investors coming in. What does this tell us about the broader Japanese market?
We think that it really highlights exactly how cheap Japan is and how many opportunities there are. As you highlight, a lot of foreign institutional investors seem to have not gotten quite the allocation that they were looking for. So that could be some incremental buying after the issue actually lists. But then we'd also highlight that looking forward into next year, a lot of retail investors will get their next allocation to their tax-free NISA accounts. And the structure incentivizes very long-term holding. So that would imply either stocks with the potential to rise very, very significantly, or perhaps for retirees, stocks like Tokyo Metro, which offer very stable, solid growth where you know that even in 10 or 20 years' time, it'll still be around. It'll still probably be generating earnings that aren't materially different from what they're doing now. So we think that both these sort of sets of investors will be quite attracted to these issues. And there are similar names on offer in Japan. One thing we've been highlighting is, for example, people have been focused on the corporate governance reforms and the buybacks. So Toyota, for example, which is such a common name, it's currently below book. Their dividend yield is almost 3.5%, and they're actually doing a similar amount of cash returns through buybacks. So if you combine the two, the implied sort of cash yield return to investors is actually slightly above 7%. And when you consider that, you know, the last time it was below book was actually just after the financial crisis, that does highlight exactly how cheap and extreme a lot of names in Japan have become.
Does the sort of predictable yield theme come at a pretty good time, given the uncertainty over China, as well as a potential prolonged period of uncertainty going into and after the US election?
We think so. I mean, in a lot of cases, investors aren't always looking to Japan for growth names. There are a few sectors or niches where there still is quite a lot of growth. But overall, we think that value is what Japan really offers the world, especially given that, you know, although recession concerns may have receded a little bit, we think a lot of investors are still a bit concerned about overall economic softness globally. And despite that, markets have held up, so valuations globally don't look especially cheap, but that isn't true of Japan. So for investors who are looking for something slightly different, we do think that the Japanese market actually offers some very interesting opportunities.
What do you think the potential upside could be when it comes to that refocusing to Japan for international investors?
Well, we think that the initial move in Japan towards the end of last year as well as early this year seems to have been driven by more shorter-term focused funds. What could really drive more sustainable and larger increases in terms of the overall market could be a greater focus on the market from more traditional long-onlys. And as we highlighted, the retail investor is also perhaps underappreciated, just given that the market has actually been relatively steadily rising since Abenomics over 10 years ago. And given that we have now actually broken new all-time highs, that should gradually focus retail investors more on potential income opportunities. And something that I guess investors have been focused on is the potential for more normalization of rates. But if a lot of retirees or just retailers in general start to see more savings income and start to be more focused on trying to generate more income from assets, that could also potentially portend a psychological shift that could be beneficial for stocks at the margin.
Kato, who's a founder of Lightstream Research. Really great to have you with us talking about the Tokyo Metro IPO today. We do have some breaking news crossing the Bloomberg. This is according to reporting in the Wall Street Journal that Frontier and Spirit Airlines have revived their merger talks. So Frontier Airlines exploring what is a renewed bid for Spirit. That's according to people familiar with the matter. Spirit continues discussions with bondholders over the terms of a potential bankruptcy filing. We saw Spirit shares earlier just in the session a couple of days ago surging on the pact to extend a key debt deadline. These two budget airlines have had these recent discussions about a possible merger, though people say these talks are still at an early stage. A deal may not come to fruition, but if there is such a deal, it could likely happen as part of that restructuring of Spirit's debt situation and some of the other bankruptcy liabilities. So, Shery, continuing to watch that story.
And Haidi, of course, as we head towards the Japan market opens, we're also watching the upcoming elections here in Japan. Support for the ruling Liberal Democratic Party appears to be softening in the run-up to this weekend's general election. The question now for Prime Minister Shigeru Ishiba is just how bad the damage could be. Bloomberg Opinion columnist Garode Reedy joins us now with the latest. And Garode, so no honeymoon bump for the new Prime Minister.
Exactly. Yeah. Typically, when a new Japanese prime minister comes in, you often see this kind of what I call a new manager bounce, which is a phrase that comes from English football, where when someone comes in, you see better results, you see better polling numbers just because they're different from the old guy. Ishiba has not really seen that. His polling numbers were better in this Jiji poll than Kishida's were, but they were still under the 30% support rate that is typically considered to be a danger zone, is the phrase that people use for it. That shows that support is quite weak. And that's obviously put Ishiba on the back foot. He made the decision to call the election very early, presumably expecting that he would see better numbers than this. And now we've got the election coming up Sunday, and it's going to be make or break time.
Garode, what are the implications and I suppose the risks for investors that are watching this?
Well, the election could go a couple of different ways. Obviously, we could see the polling numbers. The question is whether the LDP and Komeito, their long-standing coalition partner, are going to hang on to a majority in Parliament. There doesn't appear to be a great likelihood that there would be a change in government. I said that it's no longer unthinkable, but it's still not very likely. But perhaps the biggest question is, what happens if the LDP and Komeito are unable to hold on to a majority by themselves? They'll have to find another coalition partner to form a new government. That has the potential to bog down decision-making, to, so obviously there's a lot of issues that need to be tackled in Japan, whether it's trade policy, whether it's, energy policy, whether it's economic policy, whether it's, the Bank of Japan and everything that's going on there. And adding another party into the mix obviously could introduce some instability. And then you have to remember that we have the upper house election coming next summer. That would also, if there's another coalition partner involved, perhaps Ishiba can't get much done. That reduces his support. It makes it more difficult for him to get things done. That's obviously going to create more uncertainty around Japan and cloud the environment. The other possibility is that the damage is so bad that even if the LDP hangs on to power with Komeito and other smaller parties, that the results are so bad that Ishiba has to step down, and we're back into the same LDP leader election cycle as we've seen before. Investors might prefer that because if you recall the LDP election last month, many investors were more on the side of Sanae Takaichi, who was defeated in the runoff election by Ishiba. I think that if her name is certainly being suggested as a post-Ishiba candidate already, which is an extraordinary thing to be thinking about, given that Ishiba just became prime minister. But if it appeared that she might be able to get power again, I think investors would like that.
Bloomberg Opinion columnist Garrod Reedy there with what to expect from the upcoming elections here in Japan. We have more ahead on the Asia trade. This is Bloomberg.
It's now less than 3 weeks before the COP29 summit convenes in Azerbaijan, and one of the hot topics will be whether China should still be considered a developing nation in its contributions and access to climate financing. Let's cross over to Beijing. Our energy reporter Dan Murdoch joins us now. And Dan, it's always very interesting in terms of talking about, the categorization of China given the size and scope and power of its economy. What's at stake here, and what's sort of on both sides of that debate?
Yeah, so you have to go back to about 2009, which is when we came up with this modern idea of climate finance, which is you look at countries that historically emitted lots of emission, who had an early industrial revolution, who benefited from filling the atmosphere with greenhouse gases, and so who contributed the most toward climate change. And those nations, the US, the UK, Europe, developed nations, were supposed to start giving money so that developing nations could help prepare themselves for this energy transition. What's happened since then is that at the time, China's economy was still quite in the early stages of developing. And since then, its economy has grown to the second biggest in the world. It's emitted so much just in the past decade that it's now quite high up in the ranks of historical emitters. And so more and more countries like the US, like the European Union, they're looking to China to start to contribute into this climate fund. Because frankly, the developing world needs more money. Right now, the developed nations have promised about $100 billion a year. It's a goal they were late in fulfilling, but that quantum needs to raise, probably into the trillions of dollars per year. And so countries are asking, can China be a part of this? Now, China still sees itself as a developing nation. Politically, I think it might always see itself as a developing nation, as a defender of the global South. And so it's been quite hesitant to join in this sort of Western-led push. But it has other ways of, through its Belt and Road program, through other funding mechanisms, that it says it's also doing its fair share.
Dan, to elaborate on that point that you made, how much of this fight is really about the political aspect of it? And as you mentioned, China trying to portray itself as a champion of the emerging world. And how do you really try to get both sides of that argument and try to really come with a coherent solution to that divergence?
Yeah, I think it's almost all political, quite frankly. I think, every nation has budgetary constraints, of course, but that's not the real problem here. The real problem is, China sees this sort of UN financing thing as, similar to the way the United Nations and the world in general works, is it's this sort of Western-led idea, and it would prefer to have, a sort of different world order in which it has an equal stake at the playing field. And so, what China's climate negotiators have been saying is like, listen, we're not going to take any money from this fund. We know we're too wealthy to need extra financing. But what we are going to do is we're going to give money through our own means. And I think what you're going to have to see at these COP negotiations is if there's going to be a compromise, it's going to come about by people sort of finding a way to understand China's contributions and be able to tell their own people at home, listen, we're going to increase ours. We see, maybe China won't join us into this, but we see them doing enough on their own that, it gives us the confidence that, we can raise our level of commitment and actually think that we're going to make a solution here.
Energy reporter Dan Murdoch there joining us from Beijing. We have more ahead on the Asia trade. This is Bloomberg. The latest from the corporate front, HSBC's biggest overhaul in at least a decade has raised more questions than answers for some investors and staff. The plan does not reveal how many jobs are at risk from the mergers of two major businesses and the closure of some regional divisions. Shareholders are also left wondering how much money the changes will save. HSBC says it won't provide further details before full-year results next February. Hyundai Motor India slumped 7% in its Mumbai trading debut after the nation's largest ever IPO drew a poor response from retail investors. South Korea's Hyundai Motor sold 17.5% stake in the Indian unit in the deal. Analysts say individual traders were turned off by the parent getting all of the proceeds, as well as cooling demand in India's auto industry. Starbucks shares fell in extended trading after the company pulled its guidance for 2025. The coffee chain reported its steepest quarterly sales drop in 4 years, with weakness especially evident in the U.S. and China. Starbucks says withdrawing guidance for the current fiscal year will give new CEO Brian Niccol an opportunity to solidify a turnaround plan.
Shery, take a look at some of the stocks that we're watching in terms of the biggest moves and the drivers, right? Starbucks and McDonald's, of course, were two of those names that we were watching in the overnight session. Starbucks continuing to see that downside of over 4% there, suspending the 2025 guidance after another sales slump there, and the fourth quarter preliminary comparable sales numbers missing expectations. So the steepest quarterly sales drop in 4 years. The CEO saying that the coffee chain needs to change its strategy. We're also watching Texas Instruments there, up by about almost 4%. They're saying it's nearing a recovery after that slump in sales. L'Oreal also in focus, those sales being hurt by that deepening demand slowdown in China.
This is Asia Trade. We're counting down to Asia's major market opens with some gains in the Australian market early in the session today. Kiwi stocks under a little bit of pressure, of course. We had sort of a mixed finish across U.S. markets overnight. A little change on the S&P 500, which fell marginally. Traders continuing to cut bets of aggressive Fed easing. Not to mention that, of course, we're reacting to some idiosyncratic events. McDonald's, for example, plunging after being linked to an E.coli outbreak across the United States. And we continue to watch the latest from the IMF. They just lowered their global growth forecast for next year to 3.2%. They're citing risks from wars and trade protectionism. As, of course, we continue to watch the Japanese yen as Japanese markets come online. Already we had seen it surpass that 151 level against the U.S. dollar. Weakness continuing as Treasury yields continue to rise, and that really pressuring the Japanese currency. We're talking about the lowest level since July and past that 151 level. The next to watch will be 151.36, which would be its 200-day moving average at the moment. And we continue to watch for the risk of intervention, of course, given that we have heard some caution coming from Japanese authorities on the weakness of the Japanese yen earlier this week. Tokyo Metro still untraded at the open. This is, of course, the big $2.3 billion listing, the biggest IPO here in Japan since 2018. Right now, it's set to rise above the IPO price of 1,200 yen. We'll be waiting for that open. But take a look at how Korea is also coming online. We're talking about some of those gains being sustained in the Korean market, up 0.25% at the moment, after we saw the Korean won now trading at the lowest level in about 3 months versus the U.S. dollar. And all of this, of course, as we continue to watch how currencies trade across Asia, there's been a lot of pressure on Asian currencies overall. We're talking about the Aussie dollar also seeing 3 weeks of losses already against the U.S. dollar. Treasury yields continuing to move higher. Treasury losses really continuing as traders are repricing what happens with the Fed rate cuts. Global bonds have been really falling this week. Take a look at how cash treasury trading at the moment is coming online in the Asian session. But Haidi, all of this, of course, as we have a big guest coming up to talk about all of the global market reaction.
Got it now. the other side and go home.
Well, Shery, we would like to welcome Bloomberg Radio listeners worldwide as we're now joined by a special guest. He runs the second largest bank in the United States and is here in Sydney to mark their 60th year in Australia. Joining us exclusively is Brian Moynihan, who's the chairman and CEO, of course, of Bank of America. Brian, really great to have you with us and we appreciate you joining us. You're here to celebrate a significant milestone. What's the mood music been like?
Well, it's been a great time to be here. Our team is celebrating 60 years in this country, and they're all excited about it. We have a great business here, and Joe and the team do a great job. And yeah, the mood's pretty strong. I mean, everybody's worried about geopolitics and all that stuff, but the day-to-day business activity, the people seem confident. Our team's having a good year in the markets business and the corporate banking, investment banking business. We wish IPOs are going faster around the world, but overall it's pretty good.
In terms of how you characterize the Australian market, how do you see it? Is it a growth market for the business?
It is. It is. We basically, if you think about the last decade or so, we tripled the size of our exposures here. Following our clients. We do corporate investment banking for large companies, treasury services to move money around the world for those companies, and then we do markets for equity investors and fixed income investors from around the world and Australian investors investing around the world. And so those businesses are strong, growth businesses in our company and growing here. And a simple way to think about it is we tripled the size of the risk we're taking in the last 10 years.
It's a fascinating time for markets at the moment, as it has been over the past few years. But I think the last time we saw Treasury sell off to this extent, Alan Greenspan was in the middle of orchestrating a soft landing. You guys are in the no landing camp. Do you think what's going on with bond markets, a recent, relentlessly resilient string of data, does that just bolster that view for you?
Yeah, and I think we not only have all the general economic work, we have the top research team in the business. They do a great job, Candace Browning-Platt leading them and all the colleagues around the world. But we also have 60 million American consumers. And so when you think about the U.S. economy, we have great insight into what's going on. If you look at that consumer spending this year, the month of October so far versus last year, or third quarter versus last year's third quarter, it's up in the 4 to 5% range, which is consistent with a low inflation, low growth economy. That's across about $1.25 trillion to $1.5 trillion spent in a quarter. So it's a big sample, and the people moving around, they spend it each quarter on all different things, but it's generally growing consistent where we were pre-pandemic when you had Fed funds rate at the 2% level, 2.5% level. You had inflation in control, and you had growth in the 2% level. So that gives us confidence that our experts to do all analysis are backed up by the data we see in our clients, and that's what we see.
For the consumer, is there a degree of bifurcation there demographically?
It's less about bifurcation because that assumes that there's sort of two. Look, inflation hits people in the lower income brackets more than it does others but the good news is gas prices have come down. Food prices have tipped over. Inflation's in control. It's down in the 3% range as opposed to it was running pretty hot. And so that helps. But if you have auto debt, that debt, and you want to get a new car, that debt is higher. If you have mortgage debt and you already had a mortgage loan, it's very low. And so it really depends on the consumer and really where they are. But the average American consumer has more money than they did before the pandemic, is in better credit quality before the pandemic, still has the money in accounts from some of this stimulus in the pandemic, and is spending money. And that's all good stuff for the U.S. economy because we're such a consumer. That's the unique thing about it. It's a consumer-driven economy. It's a consumer-led economy.
Are you thinking about making allocations or allowances for stress at this point?
We always do that. So every quarter we run stress tests, thousands of them. Every day we run them in the markets, business stuff. We always look at it. And so what's the case if it turns out the wrong way? So even how we set our reserves, we have a modeled series of cases we put in. So it's not all base case. Base case is about half, and the rest are stress cases, and you add them all together. We're actually set our reserves as if unemployment was going to be at 5% at the end of next year, not what the market predicts at 4.3. So there's a conservatism built in to that, and then we look beyond that.
There's also some potential complications for the Fed depending on what happens in just under 2 weeks' time, right? Does the fiscal scenario, particularly under another Trump administration, but also certainly there are risks when it comes to the Harris camp as well. Is that something that you're thinking about?
So I would separate a very near-term question of the Fed getting the trajectory. Our experts have them cutting again a couple more times this year, so 100 basis points this year and another 100 basis points more evenly spread each quarter next year, and gets to 3 to 3.25 as a terminal rate. And then inflation comes down to the 2.3% as we move into 25 and 26. And so that is a well-engineered Fed change. And so the danger is that data, or they go too fast or too slow. And that risk is higher now than it was 6 months ago. And so as they move, everybody's going to watch them. And you see the sell-off in treasuries one day, and you see the rally the other day. Everybody's going to watch all that. That is completely different from, and I don't think that'll be impacted by the elections at all. The fiscal problem in the United States, and to give you the soundbite, the U.S. just finished a fiscal year. The budget deficit for that year was equal to the entire economy of the country of Australia, $1.8 trillion. So think about the size of that, and we've got to get it back in line. These are good times, and we should be managing it more carefully. And frankly, we need to have the politicians who set those budgets, fund those budgets, and run tax policy against those budgets to figure out how to make this work. It's probably going to be raising revenue and cutting expense or some combination. It's not a new problem, but it's one we've got to start to wrestle with. Not that it's critical tomorrow morning, but it will be critical over the next few years.
But given that risk, do you think the Fed went too big too soon?
No, they were late to the game, and they admit that, so it's nothing that we're saying. It's they were late, and they had to move fast because inflation got ahead of them, and they've done a good job of bringing it back down from probably a double-digit rate down to about 3% last quarter, 3.25%. So they're getting close to it, and it's never. The inflation average from one of my teammates told me from 1990 to 2024 was 2.5%. The inflation average from 2000 to 2020 was 2.5%. It's 4.5% just in the last 2020 to 24, and so we've got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now, and that's what they are all trying to figure out watching the data. But whether it's a terminal rate that's the key, and that we think is around 3%. That's a whole different interest rate environment in the U.S. and other markets than it's been in the last 15 years or so. We haven't come close to that level of front end rate in a long time, and if that's what is done, that's a better place for the U.S. to be, frankly.
During the most recent earnings, you said you'd provide guidance when it comes to net interest income for 2025 next quarter.
Yeah.
What data points are you waiting on at this point?
The difference of a Fed cut or not can mean $300 or $400 million a quarter for us and stuff. So when they come, how fast they come, and all that stuff, and then also just getting closer to the near term. We try to stay with what's really relevant to investors, which is the near term path. The long term path, we have about a 2.00%, 1.93% net interest margin. That's a percentage spread. That should move back to 2.2, 2.3. That'll happen over time. The path of that will be determined by all the different things going on in the environment around us. But we are growing our NI. Not very many people are. So we grew from the second quarter to the third quarter and told people to grow from the third quarter to the fourth quarter. That's unusual. Most people are flat to down, and we're starting to grow.
We saw some really strong numbers, both on income and on margin. Is that sustainable?
Yes, in that we're actually running up margins that are actually underneath our typical margins, largely because the net interest income has to spread back out. And so as that moves up, we can get back to operating leverage. For 5 years in a row, we had operating leverage before the pandemic, and then a couple years in the pandemic, then we picked it up for about 6 or 7 quarters. We got to get back in operating leverage, i.e. growing your revenue a little bit faster than your expenses. Not a lot faster, just a little bit faster. And as NII kicks in, and the loan deposits kick in, and a $3.3 trillion balance sheet, that's what drives it. So we earned about $6.9 billion after tax. We're one of the few companies that's earned that much money many years in a row. This is our 10th year of earning more than $15 billion after tax. All good stuff. But the reality is we still have a lot more earnings growth ahead of us.
What are you seeing when it comes to deals, confidence, broader capital market activity at the moment? Do you feel like it's going to be an acceleration into the end of the year, or maybe a slowdown?
The debt capital markets are aggressive, strong, and there's a lot of issuance going on. We just issued today, and that's going on. The equity capital markets, some good views of what some IPOs are getting done. You're starting to see that set up. It appears the IPO calendar will be strong for profit-making companies going public because the investors are sitting on a lot of cash, and the IPOs over the last 6-12 months have worked. In other words, they've come out to the market and gone in the right direction. Therefore, investors are gaining confidence at the quality of the companies and what they see. We think there's a pretty good prospect for that on a go-forward basis. On M&A, it's solid, but with the uncertainty around the world on regulatory policy, getting deals done, the pace at which you can get deals done, and whether it's in Europe or the U.S. or other places, all this has slowed the activity down. But our clients are sort of chomping at the bit. They see opportunity. They see opportunity to buy companies and increase the quality of their platform. And so there's a good pipeline. It's just that we got to make sure that it gets done.
And the central bank cycle certainly helps in restoring some of that confidence, right? What about politics, though? Do you get a sense that maybe people are staying by the sidelines now until the outcome post-November is better known?
I think if you think about what's really affecting the small, medium-sized business in the United States and other countries, as you had this rapid increase in rates, because the U.S. has a fixed mortgage market, it doesn't affect landowners that quickly. It takes time to get through that. Auto loans go up, credit cards go up, but they're already pretty healthy rates. So it does affect consumers on the rate structure when it goes up, confidence-wise, opportunity-wise. It really affects small, medium-sized businesses. If your base rate, with SOFR was 50 basis points and now it's 5.5. That difference is all cost of funds for them to borrow. So that's had more of a damper on their activity than anything else. Are they waiting for the election to get done so they can figure out what the policies are going to be under whatever it's going to be a new administration, frankly, on both sides, right? Because even though Vice President Harris was a vice president, now she'll be president, or Donald Trump has been out of office for 4 years, he'll be back being president. So both those policy platforms are not well understood by businesses. But the big driver of their reluctance has been waiting to make sure final demand stayed in, waiting to make sure the rate structure came down for their activity. So they're not using their lines as aggressively as they were in normal times, and that's part because the cost of them is higher, so you're going to be more assured of the outcome. Are they investing capital? Yes, but not as strong as they will as the rate structure comes down.
Does recession risk still sort of play, or is that in the background now? Do you think if the labour market holds up, it's going to be okay?
Yeah, with an unemployment rate of 4% plus, 4.1, with a wage growth rate of 3%, and with inflation down around 3%, it is really hard to have an economist convince the world that there's going to be a recession. Now, none of that takes into account all the parade of horribles that could go on a given day. The escalation of physical wars, trade wars, bad policy, the fiscal situation in countries percolating more. Those are all things that could happen. But if you look at it from the standpoint of the United States, people are working, they're getting paid, and they're spending money, and that's a virtuous circle, because when they spend money, that means people are working. And so that's pretty good. And we've absorbed a lot of workers over the last few years and put them to work. So it is hard to predict a recession with this low unemployment and this much wage growth. That doesn't mean it can't happen fast if people lose confidence, business lose confidence. So what you should be watching is consumer confidence, small business confidence, and they're solid, although they came down a little bit. And then when they cut rates, the consumer went up a little bit. The small business is still hanging in there. So let's watch that play out over the next few months. If they get confidence that the cost of capital for them from a debt side is coming down, they'll move faster.
We talked a little bit around politics and the election. Have you spoken at length with either candidate?
We give our advice to everybody. So, I think people always ask me, what about this? Or you have a desk drawer for candidate A or a desk drawer for candidate A. We can't do that. Our company's been around since the 1780s. So, as I say, there's been a lot of tough elections in the United States since then, including that one in 1800, which they made a great play about called Hamilton. I mean, this is the United States goes through this every 4 years, as your country goes through every 3 years. It's just part of what we do. Is this one different? Everyone's different. And our job is to advise the candidates before and after as to what the best policies are for the good of the American economy and the good of America's role in the world. And we'll do that. We've been doing that for years. As CEO, I've worked with, even before I was CEO, I've worked with presidents on task over the course of time. We'll continue to do it.
A lot of your peers have endorsed a candidate. Do you have a view whose policies might be better for the economy?
We'd have a view of that, but it has nothing to do with endorsing a candidate. We in the United States have to focus on the debt situation we talked about. We have to create the conditions of growth in the core industries we have. And that's not only good for the United States, it's good for the world. If the United States is in solid conditions, the rest of the world can adapt to that. And because the size of our consumer economy helps the rest of the world, the size of our business economy helps the rest of the world. And we're codependent on them. They help us, we help them. So I think I wouldn't get into that. It's always a problem that if we say someone's good and someone's bad, somebody overreads what it is. So our job is to stay out, let the American people decide, and then we'll go work to make what's best for America and the world, honestly.
And what's best for America, is that you working within an administration? I know you get asked this all the time, but is that something that is still an open door at some point?
Our job is to get the private sector and to keep driving. What we're working here in Australia with the Sustainable Markets Initiative that I work on the auspices of King Charles, and we worked with him with a bunch of private sector CEOs to help move the transition faster on a cooperative coalition of willing basis. Our job is to work with others in other types of settings to do that. So love what I do, and I'll keep doing it as long as they'll have me.
It's a big week for Australia. We've got both the Royals and Brian, you in town as well. But I'm glad you talked about the sustainability initiative, because this has felt like a year that's been quite depressing when it comes to that energy transition. What do you, from where you sit, where do you view the impetus here?
I would not argue with you that, because that's what you read and feel. But the reality is the work that's going on because of the commitments companies have made and them living up and driving those commitments. So people sort of divorce what you're seeing as the AI revolution hits, all these initiatives to use clean energy or even clean nuclear energy and restarting nuclear plants or small modular nuclear or solar or wind. All these activities are going on strong. And so while people are debating about this in more the public domain, meanwhile, you've gone from literally 3 or 4 offshore windmills operating in the United States to about 15 or 20 now, and a bunch of them approved, and they're going in the ground. We do several $1 billion of tax credit deals in the United States. So the investment rate today, the financing rate, we committed to $1.5 trillion to fund around $1 trillion to fund around the environmental change, or about $400 billion. Our clients are demanding it. That activity is going on, and they're all working 1,000 different ways on driving it. And so I think, despite the debate about the public setting and stuff, we believe that oil and gas and things like that are critical, and we believe that green energy is critical, and we've got to make it all work together. And a country like Australia has that. You see it play out in front of the page of the papers with the energy summit going on. It's that classic dialogue. We got to keep good energy, we got to keep good power, we got to keep the economies going. At the same time, we got to make a transition, and the private sector is driving that. So I don't get depressed at all. The amount of activity I see is unbelievable.
I want to know how much you can sustain that energy for, in terms of being, of course, already one of the longest held roles on Wall Street, and you've been around for a long time. And also, happy birthday. I know that you turned 65 this month. How long do you plan on sticking around for CEO?
Well, I said, until the board. I serve at the day, on a day-to-day basis for the board, and my plan is to continue working for a substantial period of time here to help the team along. But the real job I have is to continue to build a team that will succeed me, because this company is
Talk to me about succession. Can you give us any names?
No, we wouldn't do that. That's not for public consumption. But we have a plan, and we work on it all the time, and it ebbs and flows, and people come in and out. But the idea is, it's not just the CEO; it's the whole management team, and who will be there for that CEO to rely on to, and drive the company forward. And so we're here for a moment in time. Our company's been here for 240 years almost, and so it'll go on for another several hundreds and hundreds of years. And so the idea is, we move the wood pile, and hopefully left a little bigger, and we got to leave one of the pieces that's got to be bigger is another management capability across not only the CEO but the rest of the team.
One last question. Speaking of Stroud-Watts, Warren Buffett continues to reduce his stake in Bank of America. Have you spoken to him?
No, because it wouldn't be right to speak to him about his share ownership when he owns that much of the company. But he's been a great investor. He invested $700 million, or 700 million shares in 2011, and bought another 300 million. And I think he isn't talking about it. We wouldn't talk about it. But he's been a great supporter of our company, and we benefit by that support.
Brian, so great to have you with us, and thank you so much for joining us here in Sydney. Brian Moynihan, who's the Chairman and CEO at Bank of America. Shery.
And we do have breaking news at the moment. We're now hearing that ARM Holdings is cancelling a license that allowed Qualcomm to use its intellectual property to design chips. ARM has given Qualcomm a mandated 60-day notice of the cancellation of their so-called architectural license agreement. This is according to documents seen by Bloomberg. Now, the contract allows Qualcomm to create its own chips based on standards owned by ARM. And we know that this is really escalating a legal fight. It began when ARM sued the Qualcomm, one of its biggest customers actually, for breach of contract and trademark infringement back in 2022. So now we have ARM canceling that license that allowed Qualcomm to use ARM intellectual property to design chips. We'll be really watching the semiconductor space across Asia as well. This is expected to really disrupt the broader smartphone and PC market. This is Bloomberg. Major Japanese benchmarks not doing really much right now. The Nikkei is holding steady. The Japanese yen also holding steady. A little bit of downside pressure against the U.S. dollar at that 151 level. But of course, really today it's all about Tokyo Metro's trading debut. It was the biggest IPO since 2018. Let's bring in our stocks reporter Momoka Yokoyama for more on this. And we're still waiting for that debut. But there's been a lot of enthusiasm.
Yep. So today all the eyes are on Tokyo Metro IPO. It's receiving quite strong demand from foreign investors and also retail investors. One strong reason behind this, though, is the high dividend yield. So if the investors can get shares at 1,200 yen, the dividend yield would be around 3%. That compares to the sector average of 2%. So that's quite appealing for a lot of investors. And not just companies also offering perks to the shareholders.
I know, I heard like free tempura at some restaurants, free rides, of course, that's not surprising. But why is it so important that these companies, and I'm not just talking about Tokyo Metro, but these Japanese companies really attract those retail investors?
Yeah, so Japanese company has been traditionally doling out gifts. Famously, Tokyo Disneyland operator Oriental Land offers their theme park tickets to shareholders. But it's recently getting renewed attention as shareholder demographic changes after Tokyo Stock Exchange's push for corporate governance. So close shareholders has been quite a stable, trusty shareholder base for a lot of companies. But now that they're gone, companies are trying to look for their replacement, and retail investors kind of fits in that demographic.
Bloomberg News' stocks reporter Momoka Yokoyama there. Let's bring in now Bloomberg Intelligence Asia infrastructure analyst Denise Wong. So Denise, if you take a look at Tokyo Metro, how does it stack up when it comes to industry peers for profit outlook?
Yeah, the company actually rely on transportation business for more than 85% of its profit. So the business model is very reliable. And its transport share is very secure as well, since it's focused on the city center, where railway is generally preferred over other modes of transportation for avoidance of congestions. The Tokyo population is also expected to defy Tokyo demographic trends. But actually, the outlook is quite dull because, I mean, it's a delay rather than actually avoidance. And I think the population growth will actually slow all the way to 2030, and then it could potentially decline afterwards. Tokyo Metro, unlike its peers JR East and Tokyo, it cannot expand, rely on non-transport businesses because it's primarily operated under the ground with very limited land ownership, so it doesn't actually have room for expanding real estate or other businesses.
You know, I've heard about lots of concerns about this, especially from people riding the train every day here in Japan, especially our reporter was telling us about questions about what happens to the very, very clean toilets across Tokyo. Could the IPO impact some of its services and the quality here in Japan?
Yeah, that's definitely a concern. But I mean, especially if the company focuses more on profit maximization. But actually, our experience with JR East, Tokyo, and other private railway companies suggests that the operators actually still put a great emphasis on customer experience, since that is key to attracting passengers and stimulating spending. And I think the fact that there are many shareholders who are also as passengers also help to align interests.
Bloomberg Intelligence Asia infrastructure analyst Denise Wong there. And another company set to debut today is China Resources Beverage, shares soaring by as much as 11% in the Hong Kong grey market trading session. This is the bottled water maker, raising around $649 million after pricing at the top of the range. Sources say long-only investors and sovereign wealth funds fully covered that deal book. More ahead on the Asia trade. This is Bloomberg.
a look at how sovereign bonds are trading across Asia right now, we continue to see that sell-off, really tracking what we saw in the U.S. market, with the Treasury sell-off continuing, the 10-year yield around that 4.2%. And across Japan, we're also seeing the 10-year yield continuing to rise near that 1% level. We continue to watch the Japanese yen, of course, under pressure against the U.S. dollar. We're at around that 151 level, the weakest level since July. Now, Blackstone posting an increase in third quarter profit as its credit arm was boosted by this influx of investor cash to become the firm's biggest business by assets. The credit and insurance arm took in $21.4 billion of flows during the third quarter, accounting for more than half of the company-wide total. Joining us exclusively here in Tokyo is Gilles Dellaert, Global Head of Credit and Insurance at Blackstone. It's great to have you here.
Thank you for having me. Good morning.
So we're talking about this momentum in your sector. Tell us, is it going to continue? Why?
Yeah, look, I think we're seeing this long-term structural shift towards private credit. And I think we're in the very early days. So we think it's going to continue, and I'll tell you why. It started really in direct lending, which was the first market where borrowers started to pivot from just public market execution to private market execution. That business is obviously a big business for us. We're one of the largest global managers in that space with $123 billion of direct lending assets. But that's a relatively small market. Leveraged finance in general is around $3 to $4 trillion of addressable market. What's happening now in this second phase of private credit is you're starting to see the same thing happen in private investment grade assets, i.e. the kind of financing of the real economy, which is a much larger addressable market, $25, $30 trillion or more. And as borrowers increasingly are starting to use private solutions, you're seeing the kind of flows increase in that space and the market share pick up. So we like to call it kind of like the farm to table model, where borrowers come directly to lenders or investors. Borrowers like it because they're getting speed, certainty, and flexibility. Investors like it because they earn a little bit more spread than they do in public markets at a time when public markets are tight. And that's really what's fueling this growth.
How much of that enthusiasm is coming from Asia, specifically any new projects or initiatives here in Japan?
So I would say in Asia, it's probably a little bit earlier days than it is in the U.S. or in Europe, for that matter. Our business globally is growing across the board. So we're seeing inflows from Japan, from Asia more broadly. But I think U.S. allocators have been doing this for, some period of time longer than what you're seeing here. So earlier innings, but we're seeing it across all of our client channels. And so for us, our business, if you break down the pie chart, if you will, historically, we sold drawdown funds to institutional LPs. Today, institutional LPs represent around a third of our business. The other third is insurance, and the other third is private wealth, high net worth individuals. We're active in all those channels in Japan. We obviously struck a partnership with Daiwa to distribute our credit strategies a while back. We've added partners with Nomura and Nikko Securities on top of that, so that market's growing. In insurance, we've got a long-standing partnership with Nippon Life and a number of other firms. So across the board, you're starting to see it happen. It's accelerating, but a little bit behind what we're seeing in the U.S.
How does the changing landscape when it comes to monetary policy, whether it's the BOJ trying to tighten or the Fed trying to cut but actually slowing down those rate cuts, affecting your opportunities?
Look, in general, I think what's happening in rate markets or in spread markets, that tends to be cyclical and maybe more short-term oriented. No question that we're in an easing cycle and that rates likely, end up going lower. I think for credit, what that means is maybe people will say that's going to result in less inflows into credit business or credit products. I think what's more relevant, or the better question to ask, is how do allocators look at credit or private credit when they make these allocation decisions? And what I would say there is they compare it to what they can earn in cash or in liquid fixed income or liquid credit products. Those are trading at all-time tights. Those two have come down from an earnings or all-in yield perspective. And what they really look for is the relative spread they can earn by allocating to private credit. That spread has held in very nicely, particularly in the investment grade business, where we generate around 185 basis points of excess spread on our record deployments that we saw so far year to date. And more broadly, the same applies in non-investment grade markets. So I would say the relative excess spread is what draws, investor demand, and that really is holding in. And I think that's more structural than the short-term path of interest rates as we may see it.
When it comes to the expansion of private credit opportunities globally, you've talked about wanting to seize on that momentum. Where do you see those opportunities? We've talked a little bit about Japan, but beyond that, around the world, are there sort of priority focus for you?
Yeah, look, Heidi, I would say the kind of origination side of the equation, i.e. where we find opportunities to lend or finance businesses, that applies globally. I think in markets like Japan, it's probably earlier than it is in markets like Australia, where we've been very active in our credit business. The same goes for a kind of expanded footprint in Hong Kong, Singapore, and elsewhere in Asia more broadly. We have over 500 professionals at the firm in Asia across all these offices. So we leverage our global platform with local presence, both originators, underwriters, and people that source deals. You've seen us be very active in private equity and the real estate business, both in Japan as well as outside of Japan. And I think what's happening is that as interest rates come down and the cost of capital comes down, you're seeing more M&A and general market activity, and that then in turns fuels demand for credit. So we're seeing it across the board. We're active, we're starting to be more active in local currency in all those markets to a certain extent as well. And more importantly, our investor clients want us to be present. So the demand from our investor clients across the channels that I mentioned before, institutional, insurance, and private wealth, is there, strong, picking up. And so we're very committed to the region, and we're very committed to Japan.
Regulators continue, though, to be preoccupied with the opacity of credit, right, in particular private credit, and obviously that's been the root of previous financial crises. Is Blackstone taking initiatives to try and address that?
Look, I would say credit or the extension of credit or lending inherently is not a risky business. And so what I look at is the health of the loans we're making. Break it down into the actual performance we're seeing. We finance over 3,000 corporate borrowers in our non-investment grade business. And there you saw us as part of earnings last week show our default rates continuing to be less than 0.5%. So significantly below what you see in public markets. When we're making new loans, you look at the deployments we've made so far in that non-investment grade segment. Loan to values are sub 40%. So I would say the health and the quality of the loans we're making continues to be very high. And so we're probably less concerned from a risk perspective than maybe the press and some other channels are making it out to be. I also think this is not systemic in nature. I think the advent of private markets in addition to public markets is a healthy thing for the financial system. It's a healthy thing for borrowers, for the economy. And overall, ultimately our investors invest in these products in an unlevered fashion. They own them to maturity. They own them against their long-duration liabilities. If you're, a pension fund, an insurance company, a sovereign wealth fund, that's a healthy mix, and that's probably complementary or less risky than the traditional safe model of levered bank balance sheets. And so we think net this reduces systemic risk in the system, and we've been quite voiceful about that.
Gilles, before we let you go, here in Japan, of course, there's a lot of focus on nuclear energy. A lot of focus around the world, especially with the green transition. We are seeing not only these tech giants get into nuclear investments, PE firms also. Is it something that interests you? Are you seeing any opportunities in the nuclear sector?
I would say we're spending a lot of time, as you know, in what's happening in terms of AI, data centers, and the developments in that marketplace. We're the largest owner or developer of data center assets in the world through our investments in QTS, Digital Realty, and AirTrunk. That has to get powered, and I think that requires energy transition. I think renewable energy sources alone are probably not the only answer. I think you have to go beyond that. In the U.S. in particular, we've been focused on LNG and some other utility-driven investments. I think, beyond that, what I would say is the need for the product is there. The need for power will be there. We're running into a structural shortage of power. And so as a firm, we're very focused on the kind of picks and shovels around the movement, i.e., looking beyond just the power piece, but everything else around it. Transmission lines, the grid, upgrades that will be required. And that's a different answer country by country or jurisdiction by jurisdiction.
Here in Japan?
Less so.
Gilles, good to have you with us. Gilles Dellaert, Global Head of Credit and Insurance here at Blackstone. And take a look at the broader markets trading right now, because we're seeing a little bit of a mixed picture across Asia. The Nikkei really not doing much at the moment as the Kospi is now gaining ground. And all of this really to do with the fact that we're still waiting for the trading debut of Tokyo Metro, that $2.3 billion listing, the biggest IPO in Japan since 2018, as the Japanese yen now holds at around that 151 level. A little bit more pressure against the U.S. dollars. We continue to watch the 200-day moving average at that 151.36 level, Haidi.
Shery, it's looking like a potentially quite a challenging setup when it comes to the start of trading in Europe. This is a picture when it comes to futures at the moment. Stock 50 futures looking a little bit softer. The German DAX futures, though, potentially seeing a little bit more momentum. We did see the stocks, I should say, dropping in the previous session, but ending that session well off those earlier lows. Investors continue to watch out for the rate outlook, and of course, a really busy week globally, but also in Europe when it comes to corporate earnings as well. Sentiment there also being hit by the sustained global bond sell-off. Well, ECB President Christine Lagarde says the former US President Donald Trump should visit to see how hard central banks work. That's after the Republican presidential candidate said the Fed chair had the easiest job in Washington. In an exclusive interview with Bloomberg, Lagarde also defended the importance of global trade.
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away, because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the US economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time. So it has capitalized on it since the beginning of the 21st century. And that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now. Forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month.
ECB President Christine Lagarde speaking exclusively with Bloomberg's Francine Lacroix. And we have breaking news at the moment. Japan's 40-year yield, the JGB 40-year yield, now at the highest level since 2008, surpassing that 2.54% level. And this, of course, coming at a time when we're continuing to see speculation about the Bank of Japan's rate hikes and tightening trend, but at the same time we're seeing more speculation of slower rate cuts coming from the Federal Reserve. So we have seen this ongoing not only Treasury sell-off but global bond sell-off continue this week. Now we're seeing the 40-year yield rising to the highest level in 16 years here in Japan. We have more ahead on the Asia trade. This is Bloomberg. Thailand's central bank chief says he's confident that their policy framework can withstand external shocks. Setaput Sutivartnarupe told us they're keeping an eye on risks that could arise from the U.S. presidential election and changes to Fed policy.
The U.S. economy is in a reasonably healthy state. So our baseline assumptions are for a soft landing in the United States. I think the real issue now is more about the uncertainty regarding what's going to happen on the policy front following the elections. I think everybody is waiting on that.
And you're ready to intervene because if there's any ripple effects, it'll be in your currency.
Well, Haslin, it's a broader issue, actually, if I may. It's not just on the currency front. I think in terms of policy, one thing I think that we've learned, and by we I would say it's not just Thailand. I think a lot of other countries in our situation, like Asian emerging market economies, have learned, is the importance of having a robust policy framework. And what that means is again that you don't know where the shocks are going to come from, and so it's very important to have a policy framework, be it on the interest rate front or whatever, that is robust to a wide range of outcomes. And rather than trying to fine-tune the policies to take into account specific outcomes or scenarios that you might map out, and what that means also is trying to use complementary policy tools to try to increase the leeway or the degrees of freedom that you might have. So complementing your monetary policy with, again, other instruments that you have at our disposal, including, as you mentioned, foreign exchange intervention or even macroprudential measures as part of a coordinated toolkit. I think those are the things that I think the emerging market Asian economies have taken away from the lessons from the past couple of years.
And to that point, Governor, we know that businesses in Thailand want a stable currency. They're looking at 34, 35 baht to the USD. What do you make of that, and what can the BOT do?
I mean, the fact of the matter is we're operating now in a flexible exchange rate regime, and again, trying to target a specific exchange rate level, I think would be rather counterproductive. We learned our lessons, I think, quite well in a very expensive way from the 1997 Asian crisis. So the difficulties of trying to fix or peg the exchange rate at a certain level comes with a lot of risks, and I don't think it's an appropriate regime to adopt now, particularly where there are a lot of shocks that are happening, and we want the exchange rate to be able to act again as a shock absorber in these kinds of situations.
The Bank of Thailand Governor speaking to us for Insight with Hasinda Amin, and join Hasinda for that interview in full at 11 a.m. Singapore time, 11 p.m. in New York. This as we continue to watch the Japanese yen continuing to be pressured against the U.S. dollar and now surpassing that 200-day moving average and trading at that 151.42 level at this point, down 0.2% against the U.S. dollars. We continue to see the Treasury sell-off, putting fresh pressure on the Japanese yen. Of course, we continue to get that uncertainty about the pace of the yield gap between Japan and the U.S. We do have a Bank of Japan policy decision next week. No changes expected then, but the weakening trend of the yen continuing and all eyes on potential verbal or intervention coming from the finance ministry as well. We had some comments earlier in the week as well. This is Bloomberg.
Chip designer ARM is cancelling a license that allowed longtime partner Qualcomm to use its intellectual property to design chips. Our tech reporter Annabelle Jules has more on this Bloomberg scoop. So what do we know?
Well, it's really just an escalation of a dispute that actually began a few years ago. I think we sort of need to set the context here. What's the actual relationship between these two companies? So ARM, we know it's UK-based. It's actually majority owned by SoftBank, and they license a lot of their technology to companies like Qualcomm. So these companies, as I said, do have a long-standing partnership, and really ARM's technology sort of underpins a lot of the technologies that's used for many smartphone or mobile electronics. But back in 2021, ARM sued Qualcomm, and the concern was that they weren't adhering to the terms of the licensing agreement. Now, Qualcomm countersued on this, and really the legal argument or the legal dispute has been ongoing since then. But what we've seen in a document is that ARM has given Qualcomm a mandated 60-day notice of cancellation of their so-called architectural license agreement. So it's certainly just taking that dispute up a notch, and it's really just now putting sort of a time frame in focus here. This will need to be resolved within the next 8 weeks or so.
And Belle, you said it, right? I mean, this is a sort of technology that underpins many smartphones and electronics. So what could be the broader consequences?
Well, they could be really significant, Shery. And as you said, it's certainly really important technology here. But Qualcomm, as a company, sells hundreds of millions of processors annually. That's the technology that's used in many Android smartphones. So if that cancellation does take effect, then the company could indeed have to even stop selling some of its products. And this is really the products that account for most of its revenue. You're talking about maybe $40 billion being achieved overall per year. They could also face claims for massive damages. Interestingly, in the after-hours trade, you're not seeing too much of a stock reaction so far. These companies are largely flat right now. But as we said, it does certainly take this legal stoush up a notch.
Our tech reporter Annabelle Jules here. Let's get you caught up with the latest on the corporate front. And Starbucks shares falling in extended trading after the company pulled its guidance for 2025. The coffee chain reported its steepest quarterly sales drop in 4 years. Weakness especially evident in the US and China markets. Starbucks says withdrawing guidance for the current fiscal year will give new CEO Brian Niccol an opportunity to solidify a turnaround plan. HSBC's biggest overhaul in at least a decade has raised more questions than answers for some investors and staff. The plan does not reveal how many jobs are at risk from the merger of the two major businesses and the closure of some regional divisions. Shareholders are also wondering how much money the changes will save. Well, that is just about it for the Asia trade. Our markets coverage continues as we look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen. Our markets coverage continues with the China Show next. This is Bloomberg.